So you want to own a trucking fleet. Buy some trucks, hire a few drivers, and watch the money roll in every time a load gets delivered. That's how most people imagine this business. A truck moves goods from point A to point B. Someone pays you for it. Simple, clean, and predictable. At least that's what it looks like from the outside. And if you look at the surface numbers, it's easy to believe. The United States trucking industry generated around $906 billion in revenue in 2024. On paper, it sounds like one of the most reliable ways to build wealth, but the truth is very different. This is not a clean business. It is not simple. And the gap between what trucking looks like from the outside and what it actually is on the inside is one of the most brutal gaps in any industry you can enter. Because trucking is a business where your costs show up every single day, fixed, unavoidable, and relentless, while your revenue is uncertain, unstable, and completely outside your control. You can do everything right. Buy the right trucks, hire experienced drivers, secure solid contracts, and still lose money for years. You can build a company over decades, scale it to thousands of employees, and still watch it collapse in a matter of weeks. And for a single truck, the difference between a good year and a bad year can be the difference between making $8,000 or losing $25,000. Let's start at the beginning. The purchase price. A new Class 8 tractor, the large truck you see pulling freight on highways, costs anywhere between $120,000 and $200,000. And that's just the tractor. The trailer is separate. A standard dry van trailer adds another $40,000 to $70,000. If you want a refrigerated trailer for food, pharmaceuticals, or temperature-sensitive goods, that pushes the cost up to $85,000 or even $90,000 more. So before you move a single pallet, you're already looking at a minimum investment of around $160,000 and closer to $290,000 for a refrigerated setup. Most people entering the industry don't buy new. They go to the used market. A 4 to 7-year-old sleeper truck with 400,000 to 700,000 miles might cost between $35,000 and $75,000. It feels like a deal, but it's not always a deal because at that mileage, trucks begin entering what mechanics call wear cycles, a phase where major components start failing around the same time. The engine may need a rebuild. The transmission may fail. The emission system, required by law, often needs expensive maintenance, sometimes costing $4,000 per service. So the truck you bought for $50,000 can easily hit you with a $20,000 to $30,000 repair bill within the first year. And while it's in the shop, it earns exactly $0. But your expenses don't stop. Before you even start operating, there's a long list of regulatory requirements. You must register with federal authorities, obtain permits, pay taxes, install compliance systems, and meet safety regulations. None of these costs are optional, and none of them generate revenue. Altogether, these startup requirements can cost anywhere from $3,000 to $11,000 before insurance, before fuel, and before paying a driver. Now let's talk about operating costs. A truck doesn't just need fuel, it needs a driver. And drivers are expensive, not because they're overpaid, but because they're essential. In 2024, total driver compensation averaged nearly $1 per mile. On a truck running 120,000 miles a year, That's about $119,000 annually. Fuel is the next major cost. A loaded truck gets around 6 to 7 miles per gallon. At roughly $4.50 per gallon, fuel alone costs about $83,000 per year. Then come equipment payments, around $47,000 annually if financed. Maintenance? Even without major breakdowns, routine costs run about $24,000 per year. Insurance? Around $12,000, and often much higher for new carriers. Add smaller costs, tolls, software, taxes, dispatch tools, and you're looking at another $6,000. Total, roughly $291,000 per year to operate one truck. Now let's look at revenue. Freight is typically paid per mile. In recent years, average rates hovered around $2 to $2.50 per mile. At $2.50 and 120,000 miles per year, that's $300,000 in revenue. Subtract $291,000 in costs, you're left with $9,000, not per month, not per quarter, for the entire year. That's a 3% margin, and that's assuming everything goes perfectly. But in trucking, things rarely go perfectly. Rates fluctuate based on supply and demand. When demand is high, profits increase. But when too many trucks compete for too few loads, rates collapse. And that's exactly what happened. After the pandemic boom, thousands of new trucks entered the market, but demand slowed. Too many trucks, not enough freight. Rates dropped, sometimes below $2 per mile, even $1.50. At that point, many carriers were literally losing money on every mile they drove. Thousands of trucking companies shut down. Tens of thousands left the industry. Even large companies couldn't survive. This is the volatility trap. Your costs stay fixed, but your income can disappear almost overnight. Then there are hidden costs. One of the biggest is deadhead miles, driving empty. On average, nearly 17% of miles are driven without cargo. That means fuel is burned, drivers are paid, and trucks wear down. With zero revenue, a load that looks profitable on paper can quickly turn into a loss once those empty miles are included. Insurance is another growing risk. Premiums have surged due to massive lawsuit payouts, sometimes exceeding $50 million in a single case. One accident can make a company uninsurable. And if you can't get insurance, you can't operate. At some point, successful operators think about scaling 10 trucks, 50 trucks, 100 trucks. Scale brings advantages, better fuel pricing, lower per unit costs, and access to long-term contracts. But it also brings complexity. A large fleet isn't just trucks anymore. It's a full business. You need managers, compliance teams, HR, maintenance facilities, and strong financial systems. And if you can't manage that complexity, growth becomes a liability. Now look at two scenarios. In the best case, strong contracts, efficient operations, and controlled costs can generate significant profits. But in a realistic year, lower rates, one accident, a few breakdowns, that profit can disappear completely. The difference between success and failure is often just a few variables going wrong at the same time. And that happens every week in this industry. Most new operators fail within 2 years, not because they don't understand trucks, but because they run out of cash. Expenses are immediate. Revenue is delayed. Payments can take 30 to 60 days. Without reserves, the business collapses under its own cash flow gap. The operators who survive focus on discipline. They track every cost, secure contracts before expanding, maintain cash reserves, and invest in systems and people. Because in the end, trucking is not about trucks. The trucks are just tools. The real business is cash flow, contracts, operations, and control. And the people who win, they're not the ones who understand trucks the best. They're the ones who understand the business behind them.